As a member of Congress, I get to have a lot of really interesting people in the office, experts on what they're talking about.
This is the podcast
for insights into the issues.
China, bioterrorism, Medicare for all, in-depth discussions.
Breaking it down into simple terms. We hold
these truths. We hold these truths.
With Dan Crenshaw.
The Eagle has landed.
Welcome back, everybody. We've got a great episode today. We're going to talk about the unique role of the Federal Reserve in dealing with the coronavirus pandemic. We're also going to find out what the heck the Federal Reserve is, because let's be honest, it's not exactly clear to everybody. And to help us with that conversation, here have Robert Kaplan. Thank you so much for being on the show, Robert.
Thank you, Congressman. Thanks for having me.
And you are the Dallas Federal Reserve President. You've been CEO of the Federal Reserve Bank of Dallas since 2015. You represent the 11th Federal Reserve District on the Federal Open Market Committee, in the formulation which formulates U.S. monetary policy, and oversees 1,200 employees at the Dallas Fed. That's not small at all. You were previously a professor and associate dean at the Harvard Business School. You've authored several books. You were vice chair at Goldman Sachs, having worked in you've been working in investment banking for over 23 years. You've been involved in numerous philanthropic initiatives, and you're on the board of several companies, so you know what you're doing. And where are you from? So you're from Kansas. You went to University of Kansas and Harvard Business School. Oh, Harvard Business School. I remember, because I went to the Kennedy School, looking across the river at your very, very nice campus. And the Kennedy School of Government looks like a government building. They've since remodeled it since I left, so it looks a little bit better now. But I was always very jealous of the HBS snobs across the river. But hey, we don't have to talk.
I taught a lot. And I taught a lot of classes at the Kennedy School while I was there.
Yes, it was a fun place. Great. Well, again, thanks for being on the show and helping us. We've got a lot to navigate through. I'm not sure people realize how deeply involved the Fed is in the coronavirus. Of course, the economic side of coronavirus pandemic. But let's start a little bit before that. We'll get to exactly what lending programs are going on and exactly what the Fed is doing. But I think we need to have some background first. What is the Federal Reserve? Why does it exist? Why are central banks important?
So the Federal Reserve was created literally 100 years ago as the nation's central bank. And what do I mean by that? Nation's central bank means a lender of last resort with a mandate to promote full employment and price stability. There are 12 Federal Reserve banks in the United States. The Dallas, which is a short for all of Texas, parts of New Mexico, and Louisiana, is the 11th district. But there are 12 of us. And then there are, when we're fully staffed, there are then 7 governors. We meet formally 8 times a year. And that's the Federal Open Market Committee, where we make decisions on monetary policy for the United States. But in addition to monetary policy, the Federal Reserve supervises all the banks in the United States. We have a big supervision department here in the 11th district. We also manage a whole range of payment services. If you send a wire transfer or Fed wire, the Federal Reserve does payments. We do a lot of Treasury services for the U.S. Treasury. And then we do a big community outreach effort in each of the 12 Federal Reserve banks. But our primary thing that we're known for is monetary policy with a mandate to promote full employment and price stability.
So let's talk about how you actually implement monetary policy. And it's something we hear a lot about. What does it mean in practice?
Okay. So there's a few tools that the Fed has for monetary policy. One is the federal funds rate, which is just the short-term lending rate. Who are you lending to? You're lending to banks. Well, we set the federal funds rate that basically are interbank lending rates. Okay. And basically, this is the shortest term rate that is set, and so it's really the overnight lending rate. All the other rates along the Treasury curve are market determined. They are not determined by the Fed. And so when we want to be accommodative, stimulate the economy, we would try to keep the federal funds rate below what's in the lingo referred to as the neutral rate, which is there's a theoretical rate at which you're neither accommodative or restrictive. And if we want to tighten monetary policy, we raise the federal funds rate above the neutral rate.
So for somebody, go ahead.
Yeah. And there are a few other tools. One is the size of the Fed's balance sheet. Securities purchases is another tool, and obviously guidance about all those activities is another tool we use.
Yeah. Oh, we're not there yet. We're still dumbing down the first part of this. I want an overnight lending. What an overnight lending rate is. So for people who aren't in finance, myself included, we hear something like that and we think, okay, who's lending overnight? What exactly are we talking about?
So what it means, if you have so short-term interest rates, we set the short-term interest rates. So if you have a money market fund, the rate you earn in your money market fund tends to gravitate around the Fed funds rate. It is the short-term rate at which it's the shortest term rate at which banks and others lend to each other, and it tends to set all short-term borrowing rates in the United States. What you earn on your money market fund are set off that rate.
Right. So you don't control you control that specific rate, but that really is just meant to influence the rates that the rest of us would see in the market. With
the thought being that lots of economic activity is based on short-term interest rates. A lot of borrowing is done short term. A lot of borrowing is done along out the curve, but the short term rate has a big impact, yes, on economic activity.
And the purpose of messing with interest rates is because of your dual mandate, and that's looking at unemployment and inflation. Right. So just explain in layman's terms how the interest rate how it should be utilized to hit both of those mandates, and also maybe touch on it. Is that mandate outdated, or is it still a good mandate for the Fed to have?
I think it's still a good mandate, but we're in the middle of a crisis where we're in this situation. It tends to be a little bit. It tends to change the circumstances. But in normal times, which is most of the time. If we think that if the unemployment rate, we try to figure out, and I try to figure out in my job, what's full employment in the United States? What's the appropriate level of employment where we're quote unquote at full employment? And we got as low as 3.5% unemployment rate in this last year. But I also look at other measures of labor market slack, including in the lingo something called U6, which is including unemployment, discouraged workers, people who are working part-time who would prefer to work full-time. And so we try to gauge, is there labor slack? Are we really at full employment? And if we think that we're not, would tend to want to be accommodative. But that's what we're looking at. We try to come up with a grip on whether we're at or above or below full employment. And then the second thing on price stability, we basically said you don't want zero, you don't want deflation, you don't want zero inflation, but you don't want excessive inflation. And so we have historically set over the last several years a 2% inflation target, saying if we're plus or minus 2%, that's probably that probably defines price stability. At the moment, we've got an unemployment rate that is all of a sudden well above these levels. We can talk about that. And price stability is also, we probably have more disinflation at the moment because we've got so much slack in the economy. But in normal times, those are the two measures that I'm watching, and trying to also watch the entire economy just to get a feel for what direction are we moving in.
And I still haven't heard a really definitive explanation for this, but even before coronavirus, we were not seeing high inflation, for years, and there was a question of whether we were even past this point of excessive inflation. Can you comment on that, and what were your thoughts on that?
So here's my view. Inflation is affected by a number of factors. Normally, historically, if you had an unemployment rate of 3.5%, you would have expected lots of wage pressure and you would have expected a lot of inflationary pressure. And in those situations, historically, the Fed has had to raise interest rates because we're worried about inflationary pressures. We haven't been seeing that the last few years to me, the primary reason we're not seeing it is technology and technology-enabled disruption in the economy. What I mean by that means there's a whole range of things going on where people are being replaced by technology, and we're finding increasingly, because of technology, cheaper and cheaper ways to provide goods and services at lower prices and greater convenience. So everything, Amazon, Airbnb, Uber, you name it, all these forces have taken away or reduced the pricing power of normal businesses and have been disinflationary. And so that trend has been powerful, and I think that's one of the big reasons why we've seen muted inflation, even though we have a very tight labor market.
Does a global economy have anything to do with that too, for kind of the same reasons?
Yeah, globalization's part of it. To the extent you have disinflation outside in the rest of the world, and we're importing products, and you've got all these disinflationary trends going on, that would tend to also mute inflation. But I think technology and technology-enabled disruption, for me, and to a lesser extent globalization, are two of the big drivers.
And is it necessarily a good thing? I mean, because there's clearly trade-offs there. It seems like it's a good thing for consumers and all the things you can buy that continue to be cheap, but maybe not a great thing for workers' wages.
It has been a good thing for consumers, in that people can buy much more with the same amount of money than they could before. And one of the reasons why we allowed the labor market to run hot, i.e., in the past, the Fed would have acted before letting the unemployment rate get as low as it's gotten here. The reason we let it run hot is we wanted to see more wage pressure, and we wanted to see workers getting higher wages, and that's why we did that.
And to be fair, it did. I mean, I've looked at these numbers. I'm on the budget committee, and so sometimes these things come up, and it looks like the lowest, as far as proportionally speaking, the lowest income earners have their wages have grown the fastest, which is
they've grown faster. Yes,
that's a good thing.
Accurate.
And that's a good thing.
That is a good thing, and we think that's and the other thing that's happened is a lot of people that were not in the workforce or marginally attached to the workforce, either because of education or other reasons, were pulled into the workforce, and by running hotter, that encouraged businesses to bring those people in, and we think that was a good thing.
Okay, so I think we've figured that part out. Now I want to talk about balance sheets, because you mentioned like another tool that is on the Fed's set of toolkit is balance sheets. So what do you mean by that? What exactly are you putting on the balance sheets? Are taxpayers on the hook for this? How does this all work?
So the Fed in the last crisis. So if you go back to 2006 and 2007, the Fed maybe had a balance sheet of about $800 billion. This predates my time at the Fed. During the crisis and the aftermath of the crisis, the Fed had rates at zero for literally 8 or 9 years. And so what we also did is bought Treasury securities and mortgage-backed securities along the curve in order to tamp down rates. Basically to encourage risk-taking as another tool to try to lower the unemployment rate and get to full employment. We stopped doing that, though, and suspended that, let's say, I don't have the year exactly right, say 2013, 2014, we stopped increasing the balance sheet, or around 2015, let's say, and then we started a couple of years after that, starting to actually wind down the balance sheet and allow maturities of mortgage-backed securities and treasuries to run off the balance sheet. And we were in the process of decreasing the balance sheet because we didn't think we needed to use it anymore.
And is this what they refer to as quantitative easing?
Yeah, that's referred to as quantitative easing.
And so, I mean, effectively what we're still talking about, though, is pushing down long-term interest rates. So one tool is short-term interest rates, and this is a way to push down long-term interest rates?
It was a way to push down long-term interest rates, and we sort of suspended it and started to back off of that, after we started raising the Fed funds rate in the fall of 2015. We raised the rate for the first time in 8 or 9 years. as we got further along, we started to allow the balance sheet to run off, so we weren't having that effect. Having said all that, long-term interest rates continue to stay low. So a lot of people ask, why is that? It's not the Fed. One of the reasons long-term interest rates stayed low is the prospects for future growth became more sluggish around the world, including here. And there's some big reasons for that. One is GDP growth is made up of growth in the workforce and growth in productivity, and workforce growth has been sluggish due to aging.
Yeah.
And productivity growth has not been as robust as people might have expected. I think part of that has to do with need for more skills training, better educational attainment in the United States. But the point is, because prospects for future growth were more sluggish, even though we were not buying, we stopped buying the long end of the curve or along the curve, rates continue to be muted.
Yeah. And so, okay, last question on the basics of the Fed. And like I told you before we started recording, I'm asking layman questions here because I am one.
Good.
And I think it's easier to understand what the heck is going on if we first understand the basics about the Fed. So last question is, there's regional Federal Reserve banks. How does the Dallas Federal Reserve Bank differ from others? Is the mission different? Are there different responsibilities, or is it just purely regional?
So let me talk about what's the same and then what's different. What's the same is all of us, all 12 Federal Reserve banks have research departments, and we're all trying to figure out what's going on in our local economies, in the national economy, and the global economy. And we come together 8 times a year and we make recommendations we give our analysis of what's going on in the local, national, and global economy and make recommendations on monetary policy for the whole country. That we have in common. We work together as a system on payments, on supervision, and so there's a lot of integration across the system. What's a little bit different is each district is different. So, for example, my district, our district, the 11th district, is a very fast-growing. Texas is a very fast-growing state. We have substantial migration to the state. We have a big energy industry. We have big diversified state across the state. We have big petrochemical refineries along the Gulf, and so one of the things that I do, and we have substantial amount of immigrants in this state, as does a state like California. So part of my mission is to add something distinctive to what we do, and so we bore in here on issues and understanding issues that are unique to the 11th district and Texas economy, and also in our community outreach, we try to do things that are tailored to the needs of this economy. So what's an example? We lag in Texas educational attainment. So we spent a lot of time on that. We spent a lot of time on skills training here. We spent a lot of time on the digital divide in the 11th district because we have some of the areas of the country that lack internet and access to Wi-Fi, especially along the border. So that's how we're different. Each bank sort of adopts policies that are distinctive to the nature of their districts.
But are you able to do anything with that policy when you say focus on, say, educational attainment?
Yeah.
What authorities do you have to actually do anything about that, or is it mostly a research?
No, well, we do research, but on community outreach, my attitude is what's distinct about us. We are a convener of choice, meaning if people in this state or in Houston or Dallas or others see their issues, and we see their issues with, say, educational attainment, Dallas Fed has the ability to call a meeting among business leaders, nonprofit leaders, government leaders, and people will come, and we can be a catalyst for action. And so we do that. We take advantage of that. We do lots of things. We helped create Wi-Fi in McAllen, Texas, working with the mayor. We didn't actually spend any money. We were the organizer. We were an organizer that helped create the effort. That's where we act.
Okay. And so talking about action, let's now move to coronavirus and our current situation. The Fed's been described as being on a wartime footing. Does that mean that your mandates are still the same, or how have they changed, and how has the Fed's focus shifted since the COVID outbreak?
Well, unfortunately, as soon as this outbreak happened, and the containment efforts began, the unemployment rate, I don't need to tell everybody listening to this, has gone up substantially, and there are millions and millions of unemployed. So while we went into this with a very low unemployment rate, we're going to peak at an unemployment rate of 20% here. So this is a catastrophe from an economic point of view, hopefully with limited time frame. And so all of a sudden we start focusing on, gee, are the financial markets working? Do companies, large and small businesses, do they have access to capital? Do the markets work enough so that people can actually access the markets? And so we shifted, authorized by Congress, to doing some things we don't typically do, which is we went ahead and bought substantial amounts of Treasury securities to try to help the Treasury market function. But we also, working with Treasury authorized funds, stood up a whole range of programs to help improve market function around corporate bonds, municipal bonds, asset-backed securities, commercial paper. So this is a completely different job than the one we had and that I had 9 months ago. Our job now is to make sure the markets work, that we can build a bridge for companies and individuals to the other side of this crisis. And then our job is going to be to help implement policies that help drive down this unemployment rate so we can move toward, again, full employment over a period of time.
So when we say, maybe we can define some of these terms real quick: mortgage-backed securities, commercial paper. You say you're buying these things, we're putting them on our balance sheets. What are those things exactly, and how do they help these critical markets?
Yeah. So let's just go through how and we've had to sort of relearn the entire economic system. When big companies borrow using the commercial paper market, which is a short-term market, 30 days, 60 days, 90 days, typically market functions very well. It's huge size, and that's the way most big companies do short-term funding, usually with a backup line from their banks. If that market isn't functioning, they can't borrow short-term, and that's why you see a lot of companies that use those lines turn to their banks and say, we're not sure we can access commercial paper now. We're going to call our backup line. And a lot of banks got called on their backup lines because companies needed that money for short-term funding. Small businesses, obviously, and big businesses, but small businesses as well as big businesses, many of them had to shut down and generated no revenue at all. So every one of those small businesses pays a landlord rent. Many of them stopped paying the landlord rent. So now all of a sudden the landlord isn't getting rent, and that landlord, who's a real estate owner, they owe mortgage payments to they owe debt payments to their banks. Well, they can't make the debt payments to their banks, and all of a sudden there are a whole bunch of securities markets that are based on the idea that people will be making their payments. So those are asset-backed securities markets. Those stop functioning. Mm-hmm. Municipalities are accustomed to getting tax revenue. If they can't get tax revenue, their credit deteriorates, and how do they borrow? And they need to borrow to provide services. And so the lending markets to municipalities, commercial paper and short-term and longer-term, started to break down, and the cost of that became more expensive. And we saw that happen across every single market. And sometimes, just by the Fed saying we're willing and we're going to create a program to buy these securities, sometimes we don't have to buy much in those way of securities. It just gives confidence to private lenders that, you know what, these markets are going to work. If necessary, the Fed is going to buy securities in these markets, and so it's okay for us. And so a lot of these facilities, if we do this well, may not get fully used, but the thought that we're there gives confidence to private lenders and borrowers that they can fund themselves, and that lenders have confidence that they can lend.
Right. And in the beginning, you said the Fed is a lender of last resort, and that's functionally what that means in practice.
Right. We don't want to be big lenders here. We don't want to be putting out a lot of money, but we do want to make sure markets function, and the promise that we'll do that, I think, helps stabilize things here.
Right. And of course, there's a balance the Fed has to strike, because if you give people too much confidence to take on credit and risk, then there's a moral hazard involved.
then that's a problem. And if we go too far and we buy things of weaker credit quality, then people can get the idea that, boy, after this, I can take a lot of risk, but the Fed will come in, and that's so-called moral hazard, and that's a problem. So, and we've got to be careful about that.
So one other interesting thing you guys are doing, some research, is the social distancing index and that impact on economic activity. Can you explain what that is?
Yeah, so let me break this down in, for me, layman's language, because my team came up with this. As simple as this. We've obviously been sheltering in place. That's the extreme of social distancing, which means there's no interaction at all. Where you're at home and you might go out to get groceries and get in your car, but that's about it. Okay, so if we had to stay in that mode, we'd be in serious. The economic devastation of that is substantial. So we've got to reopen. But to reopen, some people can still work from home and be effective, but some people have to go back to a place of business. Some people, in order for a restaurant to reopen, people have to be willing to go out to eat. For retailers to reopen and malls, people have to be willing to go shop. And so in other words, they have to do less social distancing, but they understand that the less social distancing they do, the greater the risk they have that they could get sick. And so how do you balance this? And so what we're measuring is how much social distancing is declining, which on the one hand, you'd say from an economic point of view is a good thing. But on the other hand, from a health point of view, you'd say, oh my God, if you go too far with that without the right precautions, more people are going to get sick and we're going to be back, with cases spiking, which we've got to avoid. So this is why there's a whole range of procedures, which include, and then no one of them is going to solve this problem, but more testing so that people can with confidence know when they're going into a place that maybe people don't have the virus. Continued social distancing even in public places, wearing masks. When somebody is diagnosed, this so-called contact tracing, that you track down very quickly who they've been in contact with so they can be warned and they can quarantine. All those wiping down surfaces, although there's debate about how quickly all those things, there's a trade-off right now. The more we can reduce social distancing, the more jobs will come back and the faster we can grow and the more businesses can get online and back in business. On the other hand, the more we do that, we take greater health risks. And the trick, which is there's no textbook for this, is how to balance those two.
Yeah, and it seems to me Texas has figured it out pretty well. I'm talking to the Dallas Federal Reserve Chairman, so we might as well talk about Texas. In Houston, it seems like it's bounced back very rapidly, and there was a lot of people who were worried about whether customers would return, whether they'd be fearful, and that doesn't appear to be the case. I'm going to be scouring the city this weekend. I'm genuinely curious.
A week ago, and I saw the same thing you're talking about.
I mean, there was just people are ready to go back, and I anticipated this. I think I got the sense that people were sick of it. I think there was a lot of fear in the beginning, and I think as we've learned more about how the virus spreads, how dangerous it is, who's really vulnerable and who isn't, people are much less fearful. It depends on where you are, and it's an extremely interesting dynamic. I wrote about it this week in the Wall Street Journal on the psychology of lockdowns and who's in favor of them and why. It's really interesting. I talked to a ton of employers. This is a really interesting it's anecdotal, but it seems to be true to everyone I speak to. Their older workers are eager to get back and less fearful. Their younger workers, who are arguably not vulnerable to this virus at all, are very fearful to come back to work. I can't explain that, frankly. I don't, because I'm not one of those young workers who believes that. I don't know. Maybe I've confronted other risks in my life that seem worse than this. But there's just a lot of interesting dynamics going on. But overall, I'm optimistic when I look at Houston and Texas in general, and see how we're doing it. I would also say we have plenty of places you can get tested here, but we don't have enough people who actually want to get tested. So right. That's an interesting dynamic too. I've talked to the governor about this, and implementing this is difficult, but to your point about testing, I think it's how we test and maybe getting it to businesses so that, like you said, they can say my employees are tested once a week, so you can feel safer coming in here. I think that matters, especially if there are spikes. Although luckily in Texas we're still not seeing spikes. Maybe the warm weather has something to do with that. There's so many factors here that are interesting. Where I'm at on this side. I've been in favor of reopening for a while now, and I think the more we understand this virus, I don't think any other states have. Maybe New York City itself, Manhattan itself, has an excuse to remain a little bit more cautious. But the reality is we haven't seen spikes anywhere ever. That's the reality, except in New York. And I think we forget that as a country. We look at our total numbers, the vast majority of which are New York City. And, I'd make the argument, that's not what this podcast is about, but I'd make the argument that we stayed locked down too long outside of New York City. And I just hope that we learned some lessons in hindsight. And because I fear, well, I don't fear, this is actually what happened. We had one crisis and we created two. And so that's where the Fed comes in, because now we need your help to an extraordinary degree. Can we go on to the Main Street program, the Main Street lending program? This. So
let me just make one comment just about what you just said. So I'm praying, literally hoping that we'll continue to increase social engagement and go from 25% of restaurant to 50% and higher, and not have a, just as you said, that we're not going to have a spike. And I hope that's true. I would prefer to see even more testing being done. And I've been saying that publicly. I think we've got to reopen. We cannot have a lockdown again, which you and I'm sure agree on that. And I think the best way this is risk management, the best way to help ensure that, one of the ways is follow good procedures, but another way is more testing, more available testing, encourage people to get tested. And eventually, for a restaurant to get to 100%, we may have to make testing, or a movie theater to get back in business, or a sporting event to happen, or people to start flying, which isn't happening to a great degree. We're going to need to have testing available, or maybe even a testing procedure where you get tested before you do some of these things, so people have more confidence to do it. Because my concern is, while we're recovering, we won't recover fast enough or to a sufficient level if we don't have more testing and make it more available, especially at some of these higher engagement type sites. And those sites employ millions of people. And that's what I'm concerned about, and that's why I've been talking about testing.
Do you have any ideas then on how to increase the production capacity? Because when we've been hearing this for a while, for months now, and specifically from my Democrat colleagues, anytime you talk about reopening, they just start screaming testing, 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 and it's not really an argument. And it's not as if the president has this checkbox and he's like, okay, Mr. President, do you want less testing or more testing? And he keeps choosing the less testing box. Like that's not what's happening. Of course, there's a production capacity issue. People. And our national labs, I believe, are still under capacity in the sense that people just aren't asking for the test. And again, we see that in Houston and throughout Texas. We have plenty of tests.
But they're also not flying on airplanes.
But we don't know. I mean, we don't know why people aren't getting tested.
Well, I track it. No, I actually track the volume, and I talk to the airline CEOs. Yeah. We're getting more volume, but not enough.
Well, that's true. I agree with that. I mean, I fly. So a lot, and they're still empty, which has been kind of nice. Let's just be honest.
Well, but it's not good for the economy.
No, it's not. Well, okay. Then I forgot where I was going.
So
with
I think
that
your
point,
objective and my objective, your objective and mine are the same, which is I want to see lower unemployment, higher GDP, and I'm watching by industry. So there's testing for containment of the disease,
right?
And then I'm talking about something in addition to that. I'm talking about testing so we can grow GDP.
Right.
That's what I'm talking about.
Right. And I know what my question was now. It's production capacity. So, because I guess the point I was getting at is I think one of the reasons people don't ask for these tests is because they're very accurate tests. They're more accurate than, say, the Abbott lab test, but they take a day or two to come back. And so And if people don't have symptoms, they see no reason to get a test. That's the other reality.
Right.
So unless a business starts to mandate it and say, hey, I want to be able to, and they might start doing that. I'm curious. This is something I'm curious to observe and see if they start doing this. But people, what they really want is what you're talking about, which is the immediate, 15-minute Abbott lab test. Now, that's much more difficult to reproduce in massive quantities because you need that machine right there at the site. And so, do you have have you guys come up with any thoughts on how we can, and the company continues to ramp it up, of course, but.
So I've talked to people across the CDC, universities, companies who are doing this. And the one thing I hear in common, this is all doable, but it would take a more coordinated national initiative. So, for example, a company who produces these tests, there's a limit to how much they're going to spend on it because this is a product that's not going to have a market 3 years from now, most likely. Mm-hmm. I hope it doesn't. You know what I mean?
Yeah.
And so I think this is one of these things. I've said this. I'd rather spend tens of billions on testing than spend trillions on the alternative. And to avoid spending trillions, I'd rather spend tens of billions. I think this probably needs to be a much more coordinated, top-down national initiative, because this to me would be at the top of my list. Not again for containment. Yes, it'll help with containment. I'm interested in getting on offense and getting restaurants at full capacity, airplanes at full capacity or near that, getting people back in stadiums, getting people back in activities that employ millions of people. And my fear is without giving people more comfort, even those you're seeing in Houston, and I spent a lot of time in Houston and talked to people, they're willing to go to a restaurant that's 25% full. Many of them I talk to are not getting on a commercial airplane. I want those people to be willing to get on a commercial airplane, but they have to feel comfortable. Testing is a way to help them feel comfortable.
Yeah, no, that's true. I mean, and I don't want to spend a lot of time on this because I do want to get to the Main Street lending facility and what that is exactly. I just talking to the administration, it's not as if they're not doing this, and I want to make sure everybody understands. It's not as if we aren't spending tens of billions of dollars just specifically on testing on both legislation pieces of legislation that we passed in the CARES Act. There was billions and billions and billions of dollars for testing. It hasn't run out yet. I think they are doing what you're saying. I mean, could it? So I'm not sure what we're not doing, I guess, is the question.
What I'm hearing across sectors is there isn't. It's siloed and it's fragmented. That's what I'm hearing from people I'm talking to. It's not coordinated nationally.
Yeah. Well, we'll have a couple other guests on coming up. Robert Kadlick, for instance, maybe he can answer some of these questions because we do have these conversations with the administration, and I just want to be fair here. I think they are. There's a lot of efforts to get that up.
I'm not criticizing any party. I'm just saying, as a person who wants to see us get this unemployment rate down and the economy growing, it's the one thing in all our work. This social distancing index, that's where we started this conversation. We want to see that social industry, that index plummet, where we have as little social distancing as necessary, and we're able to return back to normal activities safely, and that's all we're talking about here.
Right. Okay. So under the Main Street program, this is another tool in the Fed's toolkit, and this is for mid-size businesses. And
right.
So give us an overview of the Main Street lending program. How's it working? What can we expect in the future?
So there's the PPP program, which is for the payroll protection program, which is for small businesses, and there's an element of loan relief if you keep your employees on. So that's that. For bigger businesses, but who may not have sufficient access to capital, and I think there's a size limit of I think $5 billion in revenues or less, or 15,000, something like this, and 15,000 employees or less. Mid-sized businesses. This is a lending program. You still have to be credit worthy, but it's basically a way. We work. It's done through the banks. The Fed guarantees 95% of the loan. The bank still has the risk for 5% of the loan. So it's got to be a loan that the bank is still willing to make. The program has been discussed. By the way, it has not been rolled out yet. Still, there hasn't been a dollar lent in it. It's about to be rolled out, but it's intended to get mid-sized businesses who are creditworthy. It's to bolster their ability to borrow money as a bridge to get through this period.
Are you using money from the distressed industries? So there was $500 billion in money that we passed in the first CARES Act, or the big CARES Act. It's hard to even keep count of them all. But the $2.2 trillion one, is that going to this, or is this a separate vehicle?
Yeah, no, that's going to. So every one of these vehicles that we've set up is a special purpose company that we leverage, say 10 to 1 or more. So let's say to do the muni program for $500 billion of muni lending takes $35 billion of the money you authorized as the equity. The rest we borrow against it, and we've calculated that the losses are unlikely to exceed, or we hope there won't be any losses, but they're going to certainly be well less than $35 billion. The Main Street program, same thing. Special purpose company set up with a fraction of the total from the what you've authorized in Congress, and then we leverage that and we spend it. And the key to the equity, you want an amount of equity that you're confident any potential losses would not exceed that amount of equity. That's the theory.
Okay, we're gonna try and break this down into more basic terms. When you say 10 to 1 leverage, can you explain that in something that we can understand?
So basically, if you're gonna, and I forget the exact equity that's going into Main Street, but let's say hypothetical terms. Let's say Main Street is a $500 billion program.
Yeah.
Let's say the equity that goes in that special purpose company is, I don't know, I don't have off the top of my head the exact, but let's say it's $35 to $50 billion. We then, in that vehicle, leverage that like a bank. Banks are often leveraged 10 to 1. We leverage it 10 to 1, like a bank might, and then we make those loans. We guarantee 95% of the loan. So we don't want to make any loan. This is why the banks have to have skin in the game. We don't want to make any loan that a bank believes they're actually going to lose money on,
right.
Or if they're going to lose money, it's manageable loss, and that's why we're able to create it as a special purpose company with some amount of equity, but it's capitalized like a bank would be capitalized.
I see. And do we have any timelines on when businesses can start expecting this? Is it going to be too little, too late? Or, I mean, are we going to be okay here?
I mean, we worry about that, but what we're trying to do is get the intersection of what will businesses actually use? What are banks willing to do, though? In other words, it's got to be a loan banks willing to make, and we're trying to make sure that the intersection of that does not create a situation where no one shows up. But I've talked to a number of businesses who want to use this facility and are patiently or anxiously waiting for this to get rolled out.
Yeah, absolutely. And do you think the money that we've appropriated is going to be enough, or do you think there's going to be additional fiscal stimulus necessary to add to it?
I think the money you've appropriated is enough. And in fact, the last count I saw, you appropriated $500 billion. And I think with all the facilities that the Fed has announced, I think we've used something less than $200 billion of the $500 billion to do every facility that's been announced. So yes, there's plenty.
And these are loans.
There is sufficient money.
These are loans. I mean, these aren't grants, so we can expect taxpayers to be paid back that $500 billion.
That's correct. Other than the PPP, the payroll protection is the only lending activity that we're involved in where the loan is forgiven. All the rest of these are loans, and that's what's good and bad about them is the taxpayer will get their money back. Shouldn't lose money on these. On the other hand, they're just loans. And you and I both know, for a business, there's limits to how much debt you can borrow, and ultimately, we need to start making sure that the economy's reopening, that we're generating revenue, businesses are making profits, and they don't need they can service these loans, and they don't need to take on any more debt.
And this kind of brings up something I wanted to ask you about before, which a lot of people don't know the answer to. What is the Fed's budget? Are you guys self-sustaining?
The short answer is we are. I actually chair the committee that oversees the Fed's budget, and yes, we tend to generate revenue from money we lend to interest we get paid from the banks. And so we tend to be self-sustaining, yes.
Yeah, so that's a good thing. And I think people need to understand that about the Fed, that it's tax dollars are generally not, in essence, not spent on it.
That is correct. And normally, the excess, we normally make a profit every year, and that money gets swept into the Treasury typically.
Yeah. You guys also have the nicest buildings, okay? So let's, I've noticed.
Yeah, they are nice. In Houston.
Yeah, compared to like the, what is it, the brute architecture that we see throughout DC, which President Trump decided we're not doing that anymore, which is a good thing. Yeah. We have some terrible looking buildings. I want to ask about the oil industry too. And you've noted that low gas prices are actually not better for the economy. So can you explain that?
Well, I haven't said that. I've said that it's not.
I oversimplified it.
What I've said is, if you go back 20 years or 10 years, when we imported a lot of our energy needs, obviously lower prices benefited the consumer, and it was and because we were importing from overseas, it was a net positive. Today it's a little more complicated because we produce a much higher percentage of our own energy today. So when prices are low, it again helps the consumer in the same way, but it also means that the industry that is now heavily domestic is less profitable. They don't drill as much, they don't employ as many people, they don't spend as much on capital spending, and that can be negative for GDP. So today it's a lot more balanced question. And by the same token, if there were a spike in oil prices 20 years ago, that'd be bad for the United States. It means we're paying other countries for higher prices, and the consumer's paying more. Today, the consumer does pay more for somewhat higher oil prices, gas prices, but the industry spends more on capex, employs more people, and that helps GDP. So it's a more balanced picture today.
Right.
The last thing that's different is the whole economy is a lot more fuel efficient. So we're not as energy intensive, oil and gas intensive as we were.
Right, but overall, so maybe I oversimplified that question, but the conclusion seems to still be that it's not clear cut that low gas prices are overall good for the economy right now because they're
good for the consumer. They're good for the consumer, but they mean, and we've seen this recently, you're having a dramatic amount of huge drop in capex in the oil industry, lots of jobs being lost.
Yeah.
And that has a negative effect on GDP. So it's balanced.
Yeah. It kind of depends on where that consumer is, on whether it's good for the consumer. Because here in Houston, we're not very excited about it. Because the energy industry is such a integral part of our economy, which affects the rest of the economy too. Restaurants are keenly aware that their customers are coming from the oil and gas industry. They don't have those customers if they lose their jobs. And so, are you guys looking at is this within the Fed's purview? Are you looking at better ways to help out the industry, and what can we do about this?
So the issue in the industry is this: for lots of companies who went into this, they already were highly leveraged, and there are many restructurings, bankruptcies going on, and some of these companies will come out the other side, and some will, because of the nature of their cost of producing, may actually liquidate, and a lot of the service companies will liquidate. The issue with the Fed, so the answer to your question, is the Fed directly helping? It's I would say, if a company qualifies for one of these, like Main Street program or PPP, yes, they will get a loan. The problem is, in order to qualify for a Fed program, they've got to be creditworthy, and so it's very possible. The problem in the industry is that a lot of the companies are not creditworthy, and so no, the Fed programs are not going to be able to help those companies, and that would have to be other parts of the government would choose to step in and do things to help those companies. But the Fed programs, by and large, tend to be for creditworthy companies that are, if they're rated investment grade, but if they're not rated, there's a limit. They're not leveraged more than, say, to 4 to 6 times cash flow. Otherwise, they're probably not going to be eligible. So a lot of energy companies probably are not eligible for Fed programs.
Yeah, and we're looking for ways to fix that. Of course, I mean it's the nature of the industry. They are highly leveraged. It's simply the nature of the industry and the reserve base that they use, and the way that oil price that price of per barrel is calculated and what date it was used comes into this as too. This becomes a pretty complicated kind of financial discussion that I barely understand, but. I know there needs to be some changes, and I know we've advocated for some of those changes just to make it easier for them to get this credit so that they can survive long enough as demand picks up and the price of oil sort of stabilizes. Do you think it will stabilize? Do you guys have any thoughts on that?
Our view is yes. Our view is that right now we're seeing the worst of it, and we're seeing lots of oil companies shut in production. We think some of that shut-in production will come back by the end of the year. We still think U.S. production is going to decline from, say, 12.8 million barrels a day in December of 2019 to about 10.8 million barrels a day by the end of this year. But a lot of that is simply because there's not going to be enough new drilling to replace the decline curve, the rapid decline in shale. Mm-hmm. We think that depending on how fast the economy grows, that we can still get into balance. We can work off a lot of this excess inventory by the second half of 2021 if we grow more slowly by 2022. So yeah, you're starting. This is why you're starting to see a firming in the oil price.
Well, we hope so.
And as demand resumes, this is back to social distancing. As social distancing declines, people get back driving more, which we're starting. You can see it on the streets. And demand for oil improves, obviously that will help work off this excess inventory.
I asked this to another, we've only got a few minutes left, and I appreciate your time. I've asked this question to another guest, an economist we had on, I think it was John Diamond, but is there, should we be looking in the next few months at doing a sort of lessons learned, nonpartisan study on this and thinking, if this ever happens again, if there's ever another pandemic where the only option is shutting down society for a couple weeks, and I would argue it should be a couple weeks, no more of this 2-month stuff. That's my opinion, but and I think the data supports that at this point in hindsight. But is there a better way to sustain the economy? I mean, the PPP program, the $2.2 trillion, the CARES Act, all of it, it was meant to sustain the economy. It was not a stimulus. It was not a rescue. It was, I think the best word to use is a sustainment mechanism. But you noted this before, which is, you noted the chain of events that happens, which is why the Fed becomes the lender of last resort. But it all starts with revenue, all of it. And would it be better to target revenue, and is there a way to do that? And let me just think about it like a simplistic person here. Every company has a credit card, and it's an emergency credit card, and in case of a national emergency declared, they can basically charge that card to the government for whatever their lost revenue is, thereby sustaining them for a certain number of weeks. Would that be a more, obviously we couldn't have done that this time, that requires some infrastructure to be put in place. But would something along those lines be a better way to actually target future economic sustainment programs in case of a giant pandemic?
The answer is I don't know. I think, unfortunately, what I've learned from this is once you have consumers unwilling, even if the government says you can go out and do whatever you want and you're not shut down, consumers still unwilling to engage in a whole range of behaviors that generate revenue and tax revenue for businesses and tax revenue for municipalities. Once that happens, where people are scared to do certain things, you're going to have a tremendous GDP drop and unemployment spike. And you and I now, once you start talking about how do you pay for that spike, you got a bunch of choices, all lousy options.
Yeah.
In other words, it's almost like once you get in the intensive care unit, what is the best way to treat you, and where and they're all lousy choices. The trick is just to avoid getting into the intensive care unit. But once you have, I think, yes, sure, there should be a debate afterwards on what's the best way to handle it once you're in that situation.
Yeah, and then, targeting revenue seems to me to be the most efficient way to do it. The question is how, because like you said, customers won't spend money. Okay, so can a business basically charge? Can a business basically have a have a mechanism that says, okay, my new customer is the government for a short period of time. You know, maybe they have to report their revenues for the last couple months. I don't know. I mean, I think these are the kind of things we have to talk about.
So those are grants, and most businesses in this country through this have not gotten grants. They've gotten loans, which they need to pay back. And so, there needs to be a whole. We only have a few minutes, so there needs to be a whole debate about that. Whether you want to go straight to, you get transfer payments from the government if you're a business. So far in this crisis, most businesses in this country have not gotten any transfer payments from the government. They've just gotten the ability to borrow and ensure that they can borrow, which they will pay back, and the taxpayer will wind up spending zero.
Right, as we said,
those businesses.
Right, only the PPP program, which is for small businesses, is an actual grant program.
And certain industries that were identified, like airlines, where the government said, "Listen, this is a special case, and we need to give grants."
Yeah, well, it's an interesting academic exercise, and I'd encourage us all to keep thinking about it.
I agree,
because I think we did the best we could with what we had. But you know, in the age of pandemics, which is human history, we just haven't had one in a very long time, and you know, this one. Doesn't appear to be nearly as bad as we thought it was just from a health perspective. But it shows the need to be better prepared for potentially worse ones. And it would be good to have a playbook, I think. Anything else you want to add, Chairman? I really appreciate you being on.
No, nothing else to add. Thank you, Congressman. Thank you